Hi, this is Krishna Merchant, and we have with us Dhananjay Sinha, Head of Research from Emkay, on the economy, markets, and earnings. Hello, Mr. Dhananjay. The equity markets have rallied around 30 odd percent, and do you think the markets have run ahead of fundamentals in terms of earnings?
I think the reason why the market has actually bounced up so significantly this year essentially derives from the fact that there was significant expectation by the market in terms of what could happen to growth, in terms of economic growth and corporate earnings after the change of guards at the center and with the formation of new government. The expectation was that the economy will actually bounce back, earnings will get supported, there will be a lot of investments that will happen, industrial growth will be stronger. So all those expectations were actually feeding into the market behavior. So you've seen market actually rallying quite sharply over the last 12 months, reaching an all-time high. And the other factor that has been driving up the market multiples has been the continued flow of FII portfolio flows into the country, partly into equities and significantly into debt markets. So all these things have actually translated into a significant expansion in the forward multiples. So 1 year forward multiple today or till recently stood at something like 17 times 1 year forward, which is FY16. So that kind of multiple is significantly higher than the growth that has actually panned out till now. So if you look at the GDP growth, it has been somewhere in the region of 5%, a little above that. You have seen IIP growth, which has remained very, very modest and bleak, averaging at 2% year to date. And investments have not really taken investment cycle has not taken off. So in that context, it does appear that the market has actually priced in significant expansion in growth and earnings. So at 17 times multiple, if you look at historical backdrop, the corresponding GDP growth should be somewhere around 9%. And that is the level we saw in 2000, most early part of 2007, when the GDP growth was at 8.5%, 9%, and the multiple was at something like 16, 17 times. So that's the scenario now. So effectively, if the growth doesn't get materialized as the market is expecting, which is basically a V-shaped recovery, if that doesn't happen, it does appear that the market is significantly overpriced in the context of the growth that can be delivered.